All right, let's jump right into this explainer. Today, we're going to completely demystify how calculated investing can take a single, ordinary $100 bill and actually turn it into real, life-changing wealth. It sounds a lot like magic, but honestly, it's really just a matter of strategy. To do this, we're climbing what we call the risk ladder. We'll be looking at starting your investment journey, the safe havens, real estate and flipping, high risk, high reward, and lastly, the ultimate gamble. So, ever wonder how to turn $100 into 100 grand? I mean, it's a question literally almost everyone has asked themselves at some point, right? You've got $100 sitting in your pocket and you just know it could be more, but getting from point A to point B, yeah, that path usually seems incredibly murky. And sadly, this just isn't something they teach us in school. Because of that massive educational gap, investing feels, well, super intimidating. Actually, scratch that. It would have been absolutely amazing if they had taught us this. But hey, since they didn't, we're going to break it down really simply today and prove that you can start building your financial future with just a single $100 bill. Section 1. Starting your investment journey. Building the foundation. Starting right at the bottom, a high-yield savings account is a 1 out of 10 on our risk scale. It is literally the perfect foundational step. This is the absolute lowest possible risk you can take. Now, keep in mind, you aren't parking your cash here to get incredibly wealthy overnight. The real point here is that while a modest 0.7% interest rate definitely won't buy you a private jet, building this emergency fund acts as your ultimate financial shield. Imagine you just moved into a new apartment, and boom, 2 months later, the hot water heater completely explodes. Having this fund gives you instant access to your cash. It literally saves you from spiraling into debt or falling into the trap of a predatory, high-fee payday loan. It is your absolute financial bedrock. Section 2. The safe havens. Protecting your wealth. Stepping up just a tiny bit, coming in at a 2 out of 10 on our risk scale, we've got gold. Often called a safe haven, it's pretty much the original currency of our ancestors. It lasts for thousands of years, and here's the kicker. It cannot simply be manufactured out of thin air by a central bank. This really brilliantly illustrates the opportunity cost of just hoarding plain old cash. Think about this. Since the Federal Reserve was created back in 1913, the US dollar has lost 95% of its purchasing power. Yikes. But if you had a $100 nugget of gold back in the year 2000, that exact same nugget would be worth around $580 today. The gold didn't magically get bigger, the value of the dollar just shrank. And you don't even need to hoard physical bars in a safe to do this. You can easily just buy a gold ETF on a broker app at its true market value. Moving right along to Section 3, real estate and flipping. These are your growth engines. Sitting at a 3 out of 10 on the risk scale, we find the legendary index fund, alongside real estate investment trusts, or REITs. Now, this does require a little bit more risk than your basic savings account, for sure, but the potential upside, it is significantly higher. Okay, so imagine an index fund is like a giant mixed bag of Haribo gummies. A factory bundles all the most popular candies into one single bag, so you get to enjoy all the best ones without having to buy them all separately. If you just replace that candy with shares of the world's absolute best companies, think Apple, Microsoft, Amazon, boom, you've got an index fund. In fact, Warren Buffett famously won a $1 million bet, proving that this simple, low-cost, bag-of-candy approach actually beats professional Wall Street hedge fund managers over a decade-long period. Crazy, right? And here is where the magic really happens. Thanks to compound interest, if you put those index funds into a tax-protected container, something like a Roth IRA in the US or an ISA in the UK, and you just invest $100 a month at an average 7% return, you would have over $123,000 after 30 years. That little container completely shields your hard-earned profits from being taxed away. Now, if you're someone who prefers real estate over stocks, a REIT works super simply. It basically allows you to own the metaphorical front door of a massive shopping center or an apartment complex. You just pool your $100 with thousands of other people, a large property is purchased, they rent it out, and then, by law, they have to pass on 90% of all the profits back to the investors as a dividend. It is basically sweet, passive income without ever having to go fix a leaky roof yourself. All right, stepping up to a 4 out of 10 risk level, we've got buying and selling items, which most of us know as flipping. The risk here really depends entirely on your own personal knowledge and your hustle. Flipping relies so heavily on your specific personal expertise to spot undervalued items. I mean, this could be anything from vintage golf equipment, or like we saw recently, Logan Paul buying a Charizard Pokemon card for over $150,000. By scouring different marketplaces for things you actually know a lot about, you can negotiate some killer deals. You might buy a vintage RC model engine on Facebook Marketplace for $100 and then turn around and immediately relist it on a specialized hobbyist website for a really tidy profit. Section 4, High Risk, High Reward, the land of volatile investments. Okay, jumping up the ladder, individual stocks sit at a 6.5 risk level. Why so high? Well, because as the massive 1995 bubble definitely proved, luck and timing play a huge role here. You can pick great stocks using all the fundamental analysis in the world and get totally rich. But when a bubble inevitably bursts, companies you hold can literally go completely out of business overnight. There's this absolutely hilarious experiment that perfectly highlights this. It reminds us that while studying financial statements is totally great, sometimes individual stock picking is so incredibly unpredictable, you might as well just throw a dart blindfolded. In a famous simulation, 100 blindfolded monkeys throwing darts at the financial pages actually outperformed the so-called smart hedge fund managers on Wall Street. No way, right? It just really goes to show that trying to beat the market by picking single winners carries a very, very real element of chance. Accelerating to a massive 9 out of 10 on our risk scale, we're entering the highly volatile, totally unregulated realm of cryptocurrency. This is exactly where calculated investing starts bleeding heavily into pure speculation. Now, while the totally limited supply of blockchain tech actually makes inflation impossible, history shows us exactly why you should only ever invest spare cash that you are fully prepared to lose. Check out this timeline. $100 put into Bitcoin in 2015, that would have blossomed into $5,000. But say you bought at that massive all-time high in December 2017, just 1 year later, your original $100 would have crashed to be worth less than $17. Honestly, no one really knows what it's going to do next, which makes it super thrilling, but for sure incredibly dangerous. And finally, Section 5, the ultimate gamble, pure, unadulterated speculation. Yup, we're talking about the lottery. This is a 10 out of 10 on the risk scale. Despite these completely absurd 1 in 14 million odds of winning, an astonishing 57% of all Americans still buy at least one lottery ticket every single year. To really put that into perspective for you, you are literally 4,000 times more likely to win an Academy Award than you are to win the lotto. And when you look at the data, a literal 50% loss on standard scratch cards, meaning spending $100 just to win 50 back, the math is just brutally stacked against you. So why throw your hard-earned money away gambling on an impossible dream when you could be using the calculated, proven steps on a risk ladder to basically guarantee your future wealth? So I'm going to leave you with this one question to ponder. Are you going to keep hoping for a 1 in 14 million miracle, or are you actually ready to take that first $100 and start climbing the ladder yourself today?